Hare Krishna. Once again, welcome to my channel Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we are going to the chapter 11, Reversion to the Mean. And the chapter extract is your yesterday's winner will be your tomorrow's loser. So, Bogle clearly says that the reversion to the mean is the iron rule of the financial market. That's very important. So, in general, as per Bogle, we always look for a short term performance compared to a sustained long term performance. And the same thing we are following even with the mutual funds, where fund investor seems to rely less on the sustained performance over, over the very long term than a superior performance over the short term. And by default, the star ratings that we see on different websites and different portals, financial portals, they are the one who are giving the maximum weightage by selecting any fund. And that is where a common retail investor is making the mistake. And Bogle is trying to advise more on this about this in this coming chapter. So let's just understand first of all what these star ratings are. So we have different portals like we have Value Star, and we have Grow. We also have portals like Morningstar. So all these portals are giving different star ratings, and these star ratings are based on the composite of fund record over the previous 2, 3, 5, or up max up to 10 years. So if you look at this data or the star performance, so as per Bogle, the last 2 year performance is given more weightage. I'm not sure if you have heard about a term called EMA, that's called exponential moving average, where the actions in the done recently are given more importance. Similarly, in the star rating of mutual funds, these last 2 year performance are being given more weightage. So for if you are looking for a 10-year history, then 35% of that rating is being decided by the last 2 year performance. And if you are looking for a fund history or let's say 3 to 5 year, then your 65% uh, of the rating is being decided by again your past 2 year performance. So we can see that these ratings are heavily biased in favor of the recent short term performance, and they are no longer representing your long term performance. So that's very important for us to understand. And Bogle is further giving with data also, where he says that according to a 2014 study by the Wall Street Journal, only 14% of five-star funds in 2004 still held that rating a decade later. So just the 14% chance. See, we all retail investor invest for a long term, but then if you are selecting based on these mutual fund star ratings, then you just have 14% chance that you have selected the best fund. Do you really want to take those chances? And further, Bogle says that almost 35% of these original five-star rated funds drop down to even 1 star, and 50% of them drop down to 3 or less star. So this clearly shows that your past performance doesn't guarantee your future performance. And this also gives us a principle that the fund performance reverts towards the mean, or if sometimes even below. So don't rely on these mutual fund star ratings, guys. So whenever Bogle present any statement, he really backed that statement with some strong data. And I think same thing he has done in this chapter again. So if you'll see that he has presented the data between 2001 to 2006, he presented some set of mutual funds, and they have divided into uh, different quartiles, and between highest return, high, medium, low, and the lowest return. So if you look at this data, and for this, so this data has been collected between the gap of 5 years. So if you look at the left side image, so out of these 365 funds which were in highest return category, only 15% remain in the highest return. In fact, 20% move to the lowest return. And if you consider the low and the lowest return combined, so that's 19 plus 20. So that means 39% of your highest return funds moved to the low and the lowest return, and 13% of them even closed down. And the same analysis, if you try to do for the lowest return funds, again the number is 355. So 18% of these lowest return fund move to the highest return, and 6% of them still remain at the lowest return, and 43% of them merged or closed down. So in this gap of 2001 to 2006, as per Bogle, 454 funds were either merged or liquidated. So we can clearly see some sort of a randomness. If you look at the same data he did again for the next set of year between 2006 to 11 and between 2011 to 16, and here also we are getting a similar kind of a data. So if you look at the highest return 353 funds, so only 13% remained at the highest return category. 27% moved to the lowest return and 25% moved to the low return. So that means more than 50%. So that's close to 52% return to the low and the lowest one. So half of your highest return fund or your top performers move to the lowest one category. And same thing again happened with the lowest return. Again, 17% of the lowest return one moved to the highest return one. 12% still remain at the lowest return, and 26% are going to get close. So, two data we can clearly see that there are more than 40 to 50% chances that your highest return fund in a next year, in a next 5 year gap, is going to become a low and the lowest return one. And if you have somehow invested a lowest return fund, then you have 43%, between 25 to 43% chances that your fund might get even closed in the next 5 years. So with this, we can conclude two things. So most of the fund in these five quartile earn subsequent returns that were largely spread relatively equally over each performance quintile. So between 13 to 18% is we can see that their performance are varying. So they are becoming reversion to mean. So with this, we can conclude that the RTM or reversion to mean extract a powerful force on mutual fund return. There is remarkably little persistence in return among the top and the bottom funds. Because your bottom funds always doesn't remain at the bottom. We have seen from the two data that 17 to 18% even move to the highest return category. So definitely reversion to mean principle is there in your highest return to lowest return. And it ranges between this 13 to 18%. Feel free to pause this here and try to grab that data and try to extract what this data is saying. I think you will really get a huge benefit if you really understand the two data that has been shared by Boggle. Uh, then Boggle further continuing that we are being fooled by the randomness. So he has taken the title by a famous book written by uh, Nasim. So he says that the previous data dramatically while the assumption of most investors and advisors that manager skill will persist, but it does not. So most investors seems to believe that manager skill will persist, but it does not. We are being fooled by the randomness. So there is a randomness in the data, and we are being fooled by that. And that randomness is coming because of an higher principle, which is reversion to the mean. So, so as per Bogle, we have retail investors have higher chances of selecting a failure funds compared to selecting a winner funds. So let's suppose that you have picked a fund with a top quartile performance, and in the next 5 year, uh, you have just 22% chances that it is going to remain among the top quartile. So your 80% chances that your fund will not remain in the top one. And we have seen that 50 to 55% chances that it can even move slide down to low and the lowest return category. So definitely we have more chances of selecting a loser compared to selecting a winners. So don't go by these mutual fund star ratings. That's my suggestion to all of you. Let's just understand this relative returns of mutual funds. And as per Bogle, they are completely random. So the stars produced in the mutual fund fields are rarely stars. All too often, they are meteors, lighting up the firmament for a brief moment in time and then flaming out, and their ashes floating gently towards the earth. They are rare cases where skill seems to involved, but it would require decades to determine how much of a fund success can be attributed to luck and how much attributed to skill. So that's very important. Between the skill and luck, differentiating between those two things, it required decades. You cannot judge based on some 2, 3, 5, 10 year data. It is not possible. But that's where we are making the mistake, and we are mixing up the luck and assuming that as a skill. And if we make that mistake over a very long term, when we are talking about 30, 40 years of investing, we will be misguided if we take this wrong assumption. So Bogle has given you enough set of data, but if you still disagree with this thing, then as per Bogle, he's saying that we should ask the questions. And there is a very famous quote which says that the man who asks the question is a fool for a moment, but the man who does not ask is a fool for lifetime. So every time we should be asking questions. We should be inquisitive. Ask question. So the questions are, first question is that how long will the fund manager with the same staff and with the same strategy going to remain in the job? We have seen that in the previous chapter that most of the fund manager life is between 8 to 10 years, not more than that. Second thing is that if the fund asset grows many times larger, will the same results are going to achieve? When the funds can be small by sustain when it's large. So we, that also second question we should be asking, that currently, okay, whatever the AUM size is, if this AUM size become, let's say, 10 times, become depend, because as soon as the fund is going to perform, a lot of money is going to flow into that thing. So will my fund is going to perform the same thing? That should be my second question. And the third question we should be asking, that these, if my fund is charging some high expense ratio and I see also a high turnover, do you think that these will cause some performance degradation? Or do you think that the low expense and the low turnover will increase your performance? So, among these two things, you need to judge your mutual fund that you are planning to select. And the fourth question and the last one you should be asking is that will the stock market continue to favor the same kind of a stock that has been at the heart of the manager's style? By default, we all know that we always make some stocks as our favorites, and that's one of the prime reason that when people are dealing with individual stock investing, even if they have invested in some stock, even if that fund is not stock that is not performing good, they will not be able to quit, because everybody creates their own favorites and it's not easy to give up on your favorites. So based on these questions you should be asking, and if you are not getting the sufficient answer or justification for all these questions, then please don't go for that active mutual fund. Otherwise, you are going to regret in your long term investment journey. Bogle further continues that your past performance is an hazardous duty. And from the Bogle has said this statement multiple times that buying fund purely on their past performance is one of the stupidest thing an investor can do. I find one more interesting quote where it says that investing based on past performance is like driving while looking into the rear view mirror. You are sure to have a lot of accidents if you are driving like this. And we retail investors are always making this mistake. Why? Because the financial influencer or the YouTube people, and that's what even sometimes your financial advisors are also giving the same advice by looking at this fund performance, by looking at these star ratings. So all these what we are looking at a rear view mirror. We are not looking on the front side. This will definitely cause accident and severe accident in our investment journey. Now the question comes is that why it is so difficult to recognize the principle of this reversion to me. So To get the answer for this, Bogle gives a reference of a very nice book, Thinking Fast and Slow by Mr. Daniel, where Mr. Daniel says that our mind is strongly biased towards the casual explanation and does not deal with mere statistics. So we don't look at the data, we just look for some casual explanation. So whenever our attention is called for an event, the associate memory will look for its cause. But Mr. Daniel clearly says that we will be wrong, because the truth is that this reversion to mean has an explanation but does not have a cause. So that is one of the that's we have to understand the psychology of our mind that doesn't allow us to recognize this principle of RT. But now that we have seen sufficient data and we understand the psychology of our mind, then I am sure that I think my viewers will be able to understand and recognize this iron principle of reversion to mean. Bogle further continues says that this old saying that the past performance is no guide to the future is not just a piece of compliance jargon. It is a mathematics. So don't think then since SEBI has said these things, so that's why every of these mutual funds people are putting this statement, although in a small font. No, sir, it's not a compliance jargon. It is a mathematics. And a humble rule of arithmetic, you cannot avoid the mathematics. 2 plus 2 is going to be 4. It cannot become 2 plus 2, 5. That's a simple mathematics. Further in the Bogle is trying to give some very nice analogy of a stock picking expert versus the coin flippers. So let's just assume a case where you toss a coin and let's say you have some 10,000 managers, and if the heads comes, then you manager will be awarded some 10,000 for an year, and if he lose, he will be losing the same amount. So by the end of the year, you will have some 5,000 managers who are the winners now. So if you again play the game for the second year, again you have half the managers, which is 2,500. You play another year, it will be 1,250. Another year, 625, and by the end of fifth year, you have only 313. So by end of 5 years, you can see that only 313 managers are the one who are continuously making up ahead. So do you think that all of them are really skillful, or is just a matter of luck? And instead of doing this 5 year, if you do it for 10 years, then only 10 out of these original 10,000 managers will have tossed the head every year. So that means in a for a 10-year time period, having a best performing fund manager, you have just 0.1% chances. Do you really want to take those chances in your investment journey? Dear friends, don't take those chances of 0.1%. Why to make that mistake in your investment journey? So we can clearly see is that the stock picking experts are like coin flippers. And this analysis analogy has been given by Mr. Nasim, where he says that the number of managers with great track records in a given market depend far more on the number of people who started in the investment business rather than on their ability to produce profits. So you have more and more these fund managers in the industry, you will have more and more these star performers. But it is not their ability, it's not about their skill. So that's really important that we have to understand this thing. Bogle further gives some very nice reference by Mr. Todd Amson, where I think in one of his interview it has been asked a question uh, that you have said that investing in an actively managed fund as opposed to a passively run index fund is an act of faith. What do you mean? And Mr. Ted's really answers in a superb way, where he says that under normal circumstances, it takes between 20 to 800 years of monitoring performance to statistically prove that a money manager is skillful and not lucky. And even if you take only 75% to, if you want to make sure that money manager is skillful, then also you need some performance data between 16 to 115 years. Do we really have that long data for any of the fund manager available? Unfortunately, not. That means there is no way a common retail investor can differentiate between a skill and a luck. I cannot say my mutual fund manager is it a coin flipper or is it a really a true investor. I cannot do that thing. So we have to, a wise investor should always invest in a low cost index fund. That's the way to do. Now you may be asking, what, where Mr. Todd Henderson is investing? So that's being asked again in that interview. And it has been asked that where do you invest? And he clearly says that in Vanguard's index fund. So he's saying that I am owning this index fund for 23 years. And he further says that once you throw in taxes, it just screws the argument for active management. And personally, I think indexing wins hands down. And after tax, active management just cannot win. And we are selecting this active management fund. And if it is not performing well, you are going to sell your units. You have to pay some taxes there. So if you are paying taxes, again, you are going back to again searching for a next best performing fund. And after a couple of years, that fund will become further down. You again sell your unit because the reversion to mean principle is going to come. And if you are always chasing the performance and not the market return, definitely you are going to do more of these exits and buying that will incur taxes. And Mr. Ted is clearly saying that after tax, active management just cannot win. So that's playing a loser's game. So don't play the loser's game. Play a winner's game by sticking yourself to buying a low cost index fund and just get your fair share of your market returns. So I hope by now my viewers are pretty clear about this reversion to mean principle. They must be very sure that this yesterday's winner cannot become your tomorrow's. Yesterday's winners are going to become your tomorrow's loser. Feel free to go through this video once again if something is not clear. I think the whatever learnings that you are going to get from this chapter, it will be tremendous if you really understand every part of this chapter. So thank you for staying with me. I hope you got something out of this from this session. If you really like this kind of a content, then feel free to like, share, and subscribe. Make sure that more and more retail investors join to this purposeful prosperity and they can avoid being remain at a stupid level. So thank you once again. I'll come again with the next chapter. Till then, Hare Krishna.